Welcome to Breaking News to Trading Moves.
Glad to be here.
Today we're zeroing in on a transaction that really seems to put a price tag on reliability.
Right. We're talking about Vistra's recent acquisition of Cogentrix Energy.
We're going to look at the details of this deal to see what the immediate market implications might be based on the information we have.
And this is a bit more than just standard industry news.
How so?
Well, this deal, it's all about power generation, and it's maybe the clearest signal yet of how the explosive demand from AI and data centers is directly influencing the energy markets.
It all comes back to that need for reliable, always-on electricity.
Exactly.
So let's nail down the core event here. Vistra, that's ticker VSET, is acquiring Cogentrix Energy from Quantum Capital.
And the headline number is pretty big. The total transaction is valued at approximately $4.7 billion.
And that's a mix of cash, stock, and assumed debt.
That's right. And that $4.7 billion figure is really where the story begins. It's a big valuation, but the why is what's important here.
So what's the context? What are they getting for that money?
Vistra is buying 5,500 megawatts of natural gas power capacity. This is firm, dispatchable power.
The exact kind of power those data centers need. The ones that can't tolerate even a minute of downtime.
Precisely. That's the demand they're buying assets to serve.
So we're really looking at the price of certainty in a world that needs more and more electricity. Let's look a bit closer at Vistra's play here.
Okay.
What exactly are they purchasing, and why is that specific portfolio so valuable right now?
They're acquiring 10 modern natural gas plants. The assets themselves are good, but, their location is the real strategic win.
Where are they?
These plants are positioned right inside the three most crucial and most competitive U.S. power markets.
And that would be PJM, ISO New England, and ERCOT.
That's them.
For our listeners who might follow energy but maybe not all the grid acronyms, can you just quickly sketch out what those three regions are?
Good question. Yeah, you can't really get the market impact without the geography. PJM is the huge grid operator for the Mid-Atlantic all the way to Chicago. Think Philadelphia, D.C.
Okay, the industrial corridor.
Right. Then ISO New England covers the Northeast states. Both are just dense population and economic centers where data center growth is really picking up speed.
And ERCOT.
ERCOT is, of course, the independent Texas market. If you're building massive data centers, you want to be in one of those three places for connectivity and, well, for economic reasons.
So Vistra is basically buying property right in the path of all this growth.
That's a good way to put it.
The analysis makes it really clear that this deal highlights the need for what's called firm generation. Could you clarify that concept for us?
Absolutely. Firm generation just means power that's available all the time, 24/7.
It's not dependent on the weather.
Exactly. Not dependent on the sun shining or the wind blowing. It's traditionally your gas, nuclear, or hydropower. And because a data center's entire business model depends on 100% uptime, they have to contract for firm power.
So this Vistra acquisition sends a signal.
It does. It signals that because firm capacity is so scarce and so in demand, the market is probably bracing for more M&A, more mergers and acquisitions in the U.S. power sector.
And if everyone is chasing the same limited resource, that suggests certain trends. The analysis points to this deal raising expectations for power prices, for capacity payments, and for regional gas demand.
All across those three markets, yes.
Why are capacity payments so crucial in this equation?
Because capacity payments are basically what generators get paid just to be available, just to exist and be ready to run.
Like a retainer fee.
Exactly like a retainer fee for a mechanic. You pay them just to make sure the shop is open and the tools are ready the second your car breaks down. Capacity payments make sure Vistra's plants are ready to fire up the moment the grid needs more power.
So when a major player like Vistra pays $4.7 billion,
it's a public declaration that the value of that capacity, that retainer fee, is going up.
That makes the whole picture much clearer. So if Vistra is betting that much on the future value of firm capacity, let's follow that logic. Who else stands to gain?
Okay, so the first category is probably the most direct beneficiary. Gas-heavy power generators and what they call merchant power platforms.
Right, because they are sitting on the exact type of assets Vistra just paid a premium for.
That's it. This growing data center load makes firm power capacity much more valuable. That supports better electricity prices and those capacity market dynamics we just talked about.
Which means higher cash flows for these companies.
Exactly. So beyond Vistra itself, that's VST, you look at companies whose business model leans heavily on gas-fired generation.
Who are we talking about?
The list includes NRG Energy Incorporated, ticker NRG. Also Constellation Energy Corporation, ticker CEG.
And they also have nuclear, which is another firm power source.
A very important point. And finally, Talon Energy Corporation, ticker TLN. All of them are well-positioned in these key markets.
Okay, so generating the power is one piece, but running these plants nonstop, that takes a lot of support. That brings us to the second category of potential winners.
Great equipment, gas turbine servicing, and components.
This sounds like a classic downstream benefit.
It is. If these plants are running harder to supply those always-on data centers, utilization goes way up. More utilization means more wear and tear.
And that drives demand for everything from new turbines to service agreements, controls, all of it.
All of it, the whole ecosystem around the power plant.
So who benefits from that increased spending?
Well, the material points to GE Vernova, ticker GEEV, a major turbine maker. Eaton Corporation, PLC, that's ETN. They're focused on electrical distribution.
And controls.
And controls, yes. Then there's Emerson Electric Company, ticker EMR. They're deep in automation. And Flowserve Corporation, FLS, which does pumps and critical flow control systems.
So the industrial backbone of the power sector.
That's right. Their revenue grows when the plants they service are put under more stress.
And this data center demand pretty much guarantees that stress. Our last group of winners goes right back to the fuel source itself, U.S. natural gas producers and midstream operators.
Right. The analysis calls this a power burn tailwind.
What does that mean in simple terms?
Power burn is just the industry term for gas used by power plants to make electricity. This tailwind isn't just about replacing coal anymore. This is new demand, driven specifically by the 247 needs of data centers.
So it's not seasonal like residential heating?
Not at all. It's predictable, it's growing, and it's needed 365 days a year.
That has to change the fundamentals for gas production. If these plants run more, it creates sustained demand for the producers and for the midstream companies that move the gas.
Precisely. On the producer side, you see EQT Corporation, ticker EQT, and Devon Energy Corporation, DVEN. They benefit if power generation becomes a more reliable, high-volume customer.
And the pipelines.
The midstream operators moving that gas. That includes companies like Kinder Morgan, Incorporated, KMI, and the Williams Companies, Incorporated, WMB. For them, higher flow rates are just better business.
Okay, that covers the potential winners pretty well. Now let's pivot. Every market action creates stress points somewhere else. What groups are identified as maybe facing some headwinds here?
The analysis highlights three groups. The first one is solar and inverter names. They are exposed to what's called rotation risk.
Okay, I see the logic, but can you expand on that? It seems a bit contradictory since the long-term trend is still toward cleaner energy.
It is, but the market reacts to the immediate story. And right now, the most pressing conversation is about the critical need for always-on power.
Which intermittency can't provide.
Which intermittency can't provide, so capital allocation reacts to that. Money tends to rotate, for a time, away from those intermittent or rate-sensitive plays.
Like solar and related tech.
Right, and it moves toward the assets that guarantee reliability. Today, that means gas and nuclear.
So it's an immediate reevaluation, where grid stability is the top priority for investors. The companies listed here are Enphase Energy, ENPH, and Solar Edge Technologies, SEDG. Both are big in inverters.
And also for Solar, Incorporated, ticker FSLR.
Okay, the second category here is the mega-cap hyperscalers themselves. That one feels genuinely counterintuitive.
Yeah, that one surprises people.
If Amazon and Google are driving this whole $4.7 billion deal, shouldn't they be winners? They're getting the power they need.
They're winners in securing the capacity, yes, but they might be losers when it comes to managing their costs. They're creating intense competition for a scarce resource, and that resource is getting more expensive.
So the price of reliability is going up, and power is becoming a much bigger line item on their budgets.
That's the heart of it. We're talking higher costs for their power purchase agreements, higher capacity charges, more expense just to get connected to the grid, all of it.
And that could pressure their margins or force them to spend more on CapEx.
Right. They need guaranteed power so badly, they're now having to invest in what looks a lot like utility infrastructure. The companies here are the big ones. Amazon.com, Incorporated, AMZN, Microsoft Corporation, MSFT, and Alphabet Incorporated, GOOGL.
So their own success is driving up their operating costs.
It's a classic economic feedback loop.
Okay, and the final group identified as potentially getting squeezed, big industrial players.
Energy-intensive manufacturers, yes. These are the industries that just consume enormous amounts of electricity: smelting, chemical processes, steel making.
So if regional power prices settle at higher levels in these key markets, PJM, ISO New England, ERCOT, these companies could face immediate margin pressure.
They could. And the analysis makes a key distinction here. The real impact depends on their specific location and, crucially, their hedging strategies.
Whether they've locked in long-term power costs.
Exactly. Those with poor hedging or just a lot of exposure to rising prices in these regions are the most vulnerable. We're talking about companies like Alcoa Corporation, AA, for aluminum,
LyondellBasell Industries, N.V. LYB in chemicals.
and Nucor Corporation, NUE, a major steel producer. For them, every fraction of a cent increase in the cost per kilowatt hour goes straight to their bottom line.
That provides a very clear picture of the market reaction. So let's wrap up by outlining what listeners should be tracking in the coming months.
First thing is the regulatory path. This deal is announced, but it's not closed. It needs approvals.
And the timeline for that is mid to late 2026, so any news on the approval process will be important.
Very important. And second, since this whole deal is a bet on the value of firm power, you have to watch the pricing trends.
Right. Specifically, power prices and capacity market trends within PJM, ISO New England, and ERCOT.
If those prices don't move up as Vistra expects, the thesis changes. The other key item is just future M&A activity.
More deals.
Probably.
Ah.
This deal sets a precedent for valuation. We should expect to hear more chatter about other generators looking to buy up firm assets to serve that same data center demand.
This whole situation really forces a strategic question for the future, doesn't it?
It does.
If this reliance on firm generation for data centers proves to be a lasting trend, how will that long-term balance between grid stability goals and renewable energy targets evolve in these markets? That's the question for you to think about as you track these developments.
A truly complex path ahead.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.